Joining me in the studio is John Haynes, Head of Research and Strategy at Rensburg Sheppards. So JP Morgan kicked off the US Bank's second quarter reporting season. Higher quarterly profits and net income of $4.8 billion. What can we expect from US Banks this earnings season?
Well, I think the key positive takeaway from what they released was declining loan loss provisions. Still at very high levels, and there's still a lot of problems in terms of the debt burden that the US is carrying, but clearly the stimulatory policies that have been put in place are now having an effect, and they're less of a burden than they had been. And if that is reflected across the financial sector more broadly, I think that will be greeted with a sigh of relief. So
the health of US banks are improving?
Yeah, exactly right. The fundamental business of a bank is to lend money and then get it back again, having made a profit. It shows they're getting more of the money back again. They are still burdened by the mistakes they made in the past, but the health of the economy is enabling them to get about that business in a much more efficient way. The noise in the system, which is the investment banking business, which one can never anticipate and predict very well, that was lackluster, but you don't pay very much in terms of multiples for that as an investor anyway, and I think people can look through that and almost regard it as a healthy sign that not all the money is being made in the more speculative elements of the banking business. More balance is in the system.
But I suppose increasing concerns about the implications of financial regulation passed by the Senate.
In the end, I think we've all accepted that the financial system and financial stocks are now going to be utilities for the next generation. What happened in the 90s and early part of the new millennium was these things suddenly magicked growth out of thin air. Nobody quite understood how it happened, but ultimately it was about leverage. Well, that's gone away. These businesses are utilities, taking people's savings and deploying it into the real world. They should have utility-like returns, and investors, I think, are pretty well along the curve in accepting that. Regulation is associated with utilities. We know it's going to be there. It's a pity that it's today and we get a mark-to-market on our expectations for next year's earnings. But bottom line is...
You don't think it's going to have much... I mean, one analyst I just spoke to, David Buick, actually from BJC Partners, was saying that actually this could have quite a profound impact on profits and ultimately economic growth.
It's all about timing. Going from a lax regulatory system to a properly regulated system at this point in time is inconvenient, because we would rather like the banks to be helping us through our period of slight uncertainty by allowing easy credit to flow through to consumers and businesses. But that's not the way we can do it. So unfortunately we have to bear the risk that banks are going to be, if you like, slightly more cautious about their lending policies for a greater good going forward. Certainly it's inconvenient, and certainly growth will be slower as a result of higher regulation, but it will be healthier growth and based on more strong foundations.
And you speak of slower growth. I mean, looking ahead, the three big factors influencing markets right now seem to be an economic slowdown in the US, a cooling economy in China as well, and the prospect of sovereign debt crisis in Europe spreading. Looking ahead, what does this mean for companies in both the US and Europe?
I think people got way too excited in the early part of this year. So all I'm seeing is the markets getting more realistic about what's likely to happen. The additional bad news in the system this year is the Eurozone sovereign debt crisis. We seem to be getting our arms around that issue. It looks like the ECB is almost at the point where it can actually deploy the funds that it has set aside for the purpose of supporting the euro. When that happens, I think markets will believe that it's enough to do that job. Once they do that, I think we can get back to the business of what we thought was going to happen in the first place, which was an inventory cycle turning into a fundamentally driven growth cycle where corporations who are profitable start to deploy those profits into capital expenditure, which creates jobs, which then creates a virtuous circle. That was brought to a temporary halt, I think, by everybody suddenly looking over their shoulders and going, oh my word, I'm really not sure what's happening in Europe. I think I'll stop those plans just for now.
John, thanks so much for coming to speak to us. We appreciate it. John Haynes, Head of Research and Strategy at Rensburg Sheppards.